Hello, I'm Jim Power, Chief Economist of Friends First. I'm here at an FBD Investment Seminar in Portlaoise on January the 8th, 2009. I've been asked to give FBD customers a sense of what the economic and investment environment might be like in 2009. We've come through a very challenging year in terms of the global economic performance, in terms of the Irish economic performance, and in terms of the investment performance in general. I think the reality is, looking ahead to 2009, the environment is going to remain extremely challenging. All of the major economic areas, the United States, Europe, the UK, Japan, are currently in recession, and the emerging economies are losing momentum quite rapidly at the moment. And this really reflects the legacy of the subprime crisis and the impact it's having on the global economy. At this point in time, all of the main economic indicators in the major economies are still moving in a downward direction, and until we start to see some stabilisation and bottoming out of those economic indicators, it's difficult to be terribly confident about prospects for recovery. On the positive side, oil prices have come back dramatically, food price inflation is starting to ease, and most importantly of all, central bankers are slashing interest rates and will continue to do so over the next 6 months. And also we're seeing many governments introduce strong fiscal stimulus packages into their respective economies. So in other words, governments and central bankers are currently throwing the kitchen sink at the economic difficulties, and eventually they will work. I would expect by the second half of 2009 to start to see global economic indicators stabilising, and recovery will start to gain some traction in 2010 and thereafter. However, I think it would be naive to believe that we're suddenly going to wake up and discover that the global economic cycle has improved dramatically. I think over the next 2 or 3 years, it is going to be a slower, more gradual economic recovery than we've become accustomed to in recent recessions. From an investment perspective, obviously equity market investors, and indeed property market investors, will be looking for signs of economic stabilisation and recovery before they start to put money back into play again. I think over the next 6 months, international equity investors will start to believe that the economic medicine will work and that global economic recovery will occur, and then you will start to see money being put to work in international equities. From the point of view of the Irish equity market, I think the story remains extremely negative because the whole banking sector has a very dark cloud overhanging it at the moment. So I think in terms of asset allocation, international equity markets would be much preferable to investment in the Irish equity market. From the point of view of property market investment, international property markets will eventually benefit from the likely economic recovery in 2010, but I think at this juncture property markets generally remain quite negative. In terms of the domestic property market, I believe that the residential property correction has started to run. I think you could see residential property prices falling on average by around 15% over the next 12 months before they start to recover in a modest fashion in 2010 and thereafter. In terms of the domestic commercial property market, obviously very dependent on where the Irish economy is going, and unfortunately Irish economic growth is likely to contract by 4 to 5% this year, and prospects for recovery in 2010 will be heavily contingent on what the government does in terms of restoring competitiveness for the Irish economy. So in summary, as we face into 2009, I think it's clear that the global economic and investment background remains extremely challenging. Consumer and business confidence in this country and globally remain at fairly low levels. Eventually, the official medicine that's being applied will work, but I think it's going to be a story for 2010 rather than 2009.